I received a community request to share my view on portfolio breakdown and risk. But first, we need to answer a very important question. What is a portfolio and its purpose? As without knowing this, portfolio breakdowns are meaningless. If the future were known, portfolios would not exist. And you wouldn't need any sort of diversification or different types of assets, such as bonds or precious metals, or crypto for that matter. You would just own one thing, and that is the one thing that works. The key word here is uncertainty. And that is the only reason portfolios exist, which is to reduce risk caused by uncertainty over time. It is important to mention that most investors, including myself, own a portfolio, but it only contains stocks and ETFs, which are exchange-traded funds. They can be even concentrated to 2 or 3 positions or a single ETF. But in high-level terms, a portfolio would be a mixture of assets, such as stocks and bonds. Think about it this way. A portfolio is the design to survive multiple possible futures. Assets are the tools. Once you see this, a lot of common investment advice looks a bit shallow. Most portfolio breakdowns start with percentages. 60% stocks, 40% bonds. 70% stocks, 30% bonds. It could be labeled as balanced, aggressive, conservative, you name it. But the percentages don't define risk, because the same portfolio can be low risk for one person and extremely high risk for another. But why would the same thing represent risk differently? It is simple. Because while the portfolio may be the same, people are different. So they have differences. They have different time horizon, income stability, flexibility, even behavior. So we can see from that alone that there is no such thing as a safe portfolio in general. Only portfolios that are appropriate for someone in a specific context. And that brings us to risk. First, when people say risk, they usually mean volatility. And this is a problem, because volatility is just movement in price. It is shown as drawdowns in any chart. For example, a tech-heavy ETF will go down 20% when a telecom ETF is down 5%. Whereas risk is what happens when uncertainty collides with constraints. And there are many types of risk, but we will review a few. Time, sequence, liquidity, and behavioral risks. Time changes everything. Volatility becomes dangerous when you don't have time to wait. And remember that volatility is price movement. If you are about to retire in a few years, you don't want to put your funds in volatile assets, because if there is a market downturn, volatile assets are impacted the most. You don't want to be taking out money from your portfolio to live on when you are down 20, 30 or 50%. A portfolio that looks perfectly reasonable over 30 years can be extremely risky over 3. And that is because time transforms risk. Look at the example. I have a 10-year-old son, Every month, I add a small amount of cash into his account, holding Nvidia and Palantir only. Palantir is grossly overvalued, and Nvidia is a cyclical business. In 1, 2, or 5 years, there is a big chance that they will go down by at least 50%. Perhaps they will remain there for a few years. Is that a problem? No. Why? It's not a problem because he is 10 years old. He won't need the funds, so it doesn't matter. But let's look at it from another perspective. If I am 70 years old, planning to retire in 2 years, owning Nvidia and Palantir is a big problem. My time horizon is small. If I have $100,000 in those companies and they go down by 50%, suddenly I only have 50,000. Imagine, for example, my expenses are 2,000 per month. Now, instead of having funds for 50 months, I only have cash for 25 months. It seems wrong, and it is very, very dangerous. Which brings us on to sequence risk, which is about the order of return. Two portfolios can have the same average return and produce completely different outcomes depending on the order of returns. This matters most probably when you're most often rather when you're adding or withdrawing funds. For example, retirement or career breaks, any sort of life transitions. This type of risk is why timing sometimes matters, even when the long-term returns are identical. And I will compare against time risk, the sequence risk, as it is very easy to misunderstand the two. But once you understand, it is very obvious. These two portfolios have the exact same returns. It's just different in order. Over the full period, we can see they entered the same place. But look at the path that they take to get there. Portfolio A crashes early and recovers slowly. Portfolio B grows smoothly, but then it crashes at the end. Now, if I'm not touching the money, both portfolios are mathematically absolutely identical. But if I am withdrawing money, or let's say I need the money during a bad period, well, they're not the same at all. Sequence risk is why two investors with the same returns can end up with completely different outcomes. And liquidity is the ability to exit when you need to. And this doesn't matter in calm markets, but has a place when markets are in stress mode. We have two types of liquidity. Market type, which is about whether assets can be sold at all. And we have personal liquidity, whether you can afford to wait. To think about it, I would put it this way. Many people invest in properties, which are not a liquid asset, as we know. And let's say my wife wants me to buy my dream car. I'm very happy, obviously. I would love that. But I don't have the cash, so I can sell my extra property, but I might have to wait for months in order to find a buyer. But let's be real. She might change her mind next week. I really want the car. I will sell the property at a discount because I don't have the personal liquidity. Liquidity only becomes visible when everybody needs it at once. Which brings us on to behavioral risk. It is something that we can all relate to. As investors, we are part of the system. We may have fear, overconfidence, regret, even the urge to act when, frankly, doing nothing would be better. A portfolio that looks optimal on paper can fail if it pushes the investor into bad decisions. I want you to remember that often the biggest risk in a portfolio is not the market, it is behavior. Now that we understand risk, we can look at portfolio types as a response to risk. Different portfolios exist because different people have different risks. So, we have growth-oriented portfolios. They accept volatility and drawdowns in exchange for long-term upside. We have income-oriented portfolios, which trade growth risk for inflation and credit risk. You get dividends instead. Capital preservation portfolios reduce drawdowns, but they take on the opportunity risk and inflation risk. Concentrated portfolios accept outcome risk in exchange for potential outperformance. But which is best? None of these are right or wrong. They are all a balance. Each of them have a trade-off. Each portfolio is a choice about which risks you are willing to live with. Once you understand these risks, portfolio breakdowns start to matter. At that point, allocations are not just numbers, but they are expressions of risk management. And if you ever read anything about portfolio breakdown, it should explain why a particular asset is there, what is the risk that it offsets, what risk it introduces, not just the percent that it occupies. That is when a portfolio breakdown becomes useful, when you have all those. Now, this video wasn't about telling you what to own. It was about how to think about portfolio risk. Allocations? Well, they are the final step. Understanding the risk is the first. The framework always comes first because a good portfolio isn't the one with the best assets. It is the one that survives the risks.